Hello, everyone. It's my pleasure to be here today. So, how lucky are we? We are here after lunch. so, okay, I would like to ask first question from Houston, William Houston. So, you have such a great experience in both personal and investing. Would you like to share with us?
Sure. So since the panel's private credit and or private equity and succession planning, I'll just share my experience to sort of kick it off, I guess. So I'm Will. We started a firm called Bay Street Capital Holdings, which we recently sold last year. And that succession experience was not what I would have imagined as a first time selling a business. Bay Street Capital Holdings was a wealth management firm, and we did a lot of succession planning for families that were experiencing liquidity events and that were planning for future exits to the public market. But when it was my turn to have, a succession plan, I realized that there was a lot of things that I would have done different going into it. So I think what we'll be going through on this panel is explaining not just working with certain groups that have the capital that they can deploy into these opportunities, but making sure that you're working with the right people, in the right places, and also with the right purpose, so that at the end of that transaction, you also have something where you know that you're happy to see that business be passed off and stewarded properly.
Wonderful. Thank you so much, William. So, actually, um, Karhan, he is from also a similar background. So, having financed over 400 million in loans in Australian SMEs, what trends are you observing in terms of business owners preferring for succession or exit?
Thanks. Look, there's a lot to that question. I guess I wear two hats here. So firstly, I've done a lot in the R&D space, so really early stage pre-revenue companies, and now we're looking at more the succession and the sale of businesses. So there are a lot of models coming out. We all hear about the grey tsunami. There are, in Australia, NAB came out with a report, 350,000 companies need to transition in the next 10 years ownership. People need to retire. Where are those businesses going to go? In the US, it's a huge number, 15 million companies, and then every country in the world is going to face the same problems. And there are a lot of different models, but what those models entail are different succession plans. Can you get out with a competitor? Can you get out with, you get some these sort of micro private equity models where they bring in someone in the same industry and they put some money and they run the business. Can you go to a bank and get debt? Do you have a first mortgage to be able to put towards that? There's a lot of different models that are coming out, and it'll be interesting. There's a model that I saw the other day in the US called TeamShare, and that is basically they come in, buy it, and then every year or two, the employees are able to buy a little bit more, but it has to be revalued every time. And I haven't seen the detail around the contract, but if those actually sale points are actually contracted or whether it's just the owners decide they want to raise some money from it. I don't know where it's going to end, but there has to be more solutions because otherwise the global economy is going to suffer. There are so many profitable little businesses that you just don't see. We don't understand the scale of the SME market in this country is really quite profitable, but they just don't have the 30 IRR that a private equity firm needs to be able to provide the returns to investors. So, for me and what we're doing, we don't look for the winners, we just want volume. So we just want businesses that are going to continue on, and in 5 years we'll take a little bit of equity, we'll get a dividend check. Whereas, I was telling these guys, a friend of mine who's a really good fund manager, he's doing one where he's going to bring his own management team in and do these small micro deals and wants to build it up. He's trying to raise a $40 million fund. Great. Every place, but he wants winners. So, there's a place for everything, but I think the scale of the problem is what is going to need a lot of different solutions to fit. What is a square peg, round hole, or whatever? There's going to have to be a whole lot more round pegs to go in the round holes.
Yes, wonderful. So look, there are so many business owners here. Every business owners, we understand this. Look, we are very emotionally or professionally attached to the business. So, Karhan, so how do we deal with it? How do we exit?
Look, I think it's planning, and there's nothing better than word of mouth. When I started the R&D business, we had a number of each year. We had thematics that came through, cloud computing, drones one year, whatever. It comes through. But word of mouth to me is going to be the most crucial part of this, because with a succession plan, education's been fantastic through this country, and there are a lot of businesses where kids don't want to take over their family businesses anymore. So how we deal with the problem is giving people confidence. First, a lot of people, a lot of older generation who have built businesses for 30 years, their legacy is everything to them. And so giving them that confidence that, whilst things are going to change, there's a level of confidence that there is going to be some sort of continuation of what they built. And also their employees. I employ people, and touch wood, I haven't had to let many people go over the years. And I think I've been very lucky in that. I hate to let people go. So knowing that those people are going to continue working in these businesses, I think, is a really key factor for people. And so giving them that surety, that understanding that what they've done for so long. My father was a small businessman, and if my solution would have been around in his time, he would have loved it. He ended up selling his business for spare parts to a competitor. So I think that to me is such a key factor that I think a lot of people forget, is the emotional investment that a lot of people have made in their business. I can pull it even back to the R&D. How many of us have raised money for a company from family, fools, and friends? And those are the hardest people that you would have to disappoint. I mean, they're the ones that backed from the start. They're mums and dads, they're your friends, they're your family, and to then disappoint them, to say you've got nothing from this investment. I mean, that emotional side is something that we're going to have to work, tailor, and understand better with what's coming in the future.
Thank you so much. So Cameron, next question is to you. Drawing your experience across structured finance and capital markets, how do you approach structuring private equity deals that support smooth business succession?
Yeah, thank you. So I guess thinking about it through the lens of the private investment firm that I'm in now, we're very much focused on identifying businesses in, I guess, industries that we feel that we know and can understand, and then once we've identified companies within those verticals, it's very much about alignment of interest with the existing owners and I guess their underlying motivations for exit and what that time horizon might look like. And then if we use a current live example, it's been very much about really understanding I guess the things that they are emotionally attached to that point, and what's important to them in a transaction. We've sort of found that price wasn't the most important thing to the owner in this particular case. It was really around is it being sort of held in the hands of parties that actually respect the brand, respect the culture that's been developed, and also respect the legacy that the family has created. And so in this instance, we've been able to identify a path where the existing management team is very strong, and so we've been able to give confidence that they will stay on, and ultimately the CEO will be promoted from within. we've been able to sort of recognise that the brand is strong, and so there's no need to sort of change that. But also, ironically, we sort of provided the opportunity of a quicker exit and pathway, and then found ourselves in a scenario where the owner came back to us and said they wanted a longer earn-out period because they saw the upside potential of what we were bringing alongside sort of what they'd already built. And so I think that alignment of interest, recognising those areas where they remain very passionate, and the fact that this is a legacy that they want to, when they walk away in 3-5 years' time, they want to be able to be really proud of the people that are now sort of holding their baby, if you like.
Wonderful, thank you so much. So, Brett, next question is to you. So, given your leadership in private credit at Aura Group, how do you see private credit playing a role in facilitating business succession, either as a standalone solution or alongside private equity?
Yeah, great question. And actually, we probably see succession across both sides of our business. Our business provides debt capital to Australian business lenders. So obviously, those lenders will provide things such as acquisition finance for businesses. So providing the debt financing for business, or the potential business owners coming through. And, you know, we're seeing a lot of transactions done. As Giles just mentioned, we're seeing 300,000 businesses that will need to transition over the next 15 years. And, you know, if you look at the importance of the SME, mid-market corporate sector in the Aussie economy, that sector employs over 70% of the Australian workforce. So it's a pretty big issue that we've got to deal with here, and how the incoming owners come through, whether it's all equity checks through private equity vehicles, or a combination of private equity and debt coming through to acquire those businesses. Now, the other point that we see, and it's more family-orientated succession, is the exiting owners of those businesses looking to deploy that capital. And they tend to be a lot of investors on the other side of our business. So, you know, if you look at our investor base, we've got a lot of baby boomers in there who have exited their business. And for them, it comes down to preserving the capital that they have spent so long building. They do not want to lose it. And, you know, they see the investing that we do in the debt capital market, in the debt component of the capital stack of businesses, as a sustainable way to invest their capital, to protect their capital, and derive a strong income off the back of it. So, you know, I think going forward, you know, in the Australian market at the moment, private capital in debt markets accounts for about 9% of all lending in Australia. To put that in context, in more mature markets where we've seen some of these transitions, in the US, 91% of lending is done in the private market. In Europe, 63% is done in the private market. So we are in our first real rotation of businesses in Australia. We feel that private market is going to evolve and grow substantially across both equity and debt. So, I mean, we see a great opportunity there. I think for the younger generation looking for options, there are a lot of great businesses there that you can buy at a relatively low multiple. I was with a family office down in Victoria yesterday. They're looking at some food services businesses and looking at a plan where, you know, they're buying at very low single-digit multiples with a roll-up play and a view to exit into PE at a high single-digit, low double-digit multiples. So, you know, there's some of these plays that are going to come through that are going to be very interesting for that next gen coming through, and, you know, hopefully build out those legacies that have been built in those businesses moving forward.
That's wonderful, actually. So I would like to ask next question from both William and Karhan. So what makes SMEs attractive target for succession-focused private equity, and where do we see the most untapped value? Because you also have a background. So.
I think for the investors here, when it comes to choosing a manager, Our jobs as investors, as fund managers, is to identify potential and see the upside return, see that I can buy something at a smaller multiple and roll it up before everyone else in the room does, right? Like if we're all looking at a deal and then we all recognize that there's value there, like we can't make any money, right? So it's not just finding the businesses that are profitable that can be purchased at a good price. But when I said earlier, like investing in the right people with the right purpose, I have a view that each of us as fund managers, we all have very various experiences, So my first business being in Asia for 10 years, me going to an Indian church for over 15 years, like my set of relationships and experiences in life give me a competitive edge in certain markets where I might not be an appropriate manager. So when you talk about unlocking value, I would really sort of say, well, it depends where, and it depends on what type of family and if they share the same worldview as the fund managers that you are investing in. Because if so, you likely can continue to derive alpha in a manager that has the right set of experiences. And they're not just identifying the right opportunities, but they are able to unlock this with additional value add beyond just money, because each of the managers are going to have funds to deploy. It's which one can properly steward that business once it's been invested in. And often if the transaction doesn't go as planned, it's in my view, what I've seen is typically there's been some mismatch, not necessarily with the opportunity, but with the acquiring business, yeah?
Yeah, look, I 100% agree. I guess I look at it from a different lens, in that I look at it from a volume rather than a value. So for me, what we're doing, we're trying to provide, well, we do provide a surety over the management buyout. So we let the managers buy the company off the owner, and then all we do is we insure it. So we say, vendor, you'll get your money over 5 years, and if not, come knock on my door and I'll pay it out. So it's a different model to trying to find the winners that are going to go somewhere. Both very valid ways of looking at things, but we're looking at it at a volume. So we want companies that, track like this, maybe track a little bit down or maybe track a little bit up. We don't need the 30 IRR. It's just two different models. It's like when I started Rocking Horse, it was Macquarie were doing big loans. I went, all right, I'll do small ones. As I said before, we need a lot of different models here, because this problem is going to be huge across the globe. And there's no one model that's going to win here. We need lots and lots of different models, because economies will suffer hugely without them.
What do you think? Oh, thank you so much. What do you think, Cameron, based on your experience and knowledge?
Yeah, sure. So I think on the manager side and the investor side coming into the managers, like the guy said, it comes back again to that notion of alignment of interest. And so there's an alignment on the succession planning side for the exiting founder or the exiting family, but it is also about the investor understanding how's the deal being structured, what's the motivation of the fund manager to materialise the upside in the opportunity, and how do they share in that, and how do you as the investor share in that. And so we've taken an approach very much of not a traditional sort of 2 and 20 performance sort of model, but much more of a aligned co-investment where the investors come in alongside us. We share the upsides and the downsides of volatility in the valuation of the underlying business, and so we're not charging a management fee per se. We're showing that we're aligned every step of the way, but we're also looking to demonstrate through our network or relationship or other adjunct businesses where the upside can come beyond, I guess, the traditional organic growth that's been sitting inside that sort of long-standing family business or the like. So, yeah, I guess from our side, it's very much about making sure you're aligned with interest with the founder that's getting out, but also you're aligned in your interest with the investor. And so we're very much focused on structuring the deal so that it's at an institutional quality, and then provide access to wholesale investors such as this in a co-investment style structure.
Wonderful. Brett, would you like to share your experience on it?
I mean, ours is purely on the debt front. So what we are looking at with the lenders we work with, anything in relation to acquisition financing, you want to ensure that the asset can service. So looking for strong, profitable businesses, like Giles was saying there, we don't need hockey stick growth. It's about consistency and ability to repay. So providing that debt capital in for acquisition where you know you're going to get repaid. And for our investors, it's about capital protection. So, you know, it's all about the back-end collateral plus cash flows to support any exposures we go into.
Thank you so much. So also I would like to ask same question from Karhang and William again. So what do you think, actually from all of you, okay, what do you wish to improve private equity and business succession? What is the best tip for everyone?
Oh, look, I'll
Please.
start. Planning. I mean, you know, fortunately, there's going to be a lot of opportunities for people to exit businesses that they've grown and that they've had for a long time, and so it's actually planning on how that will look. You know, is it the management buyout? Is it private equity? Is it a sale to a competitor? Is it shutting the doors? You know, as I said, that's the hardest decision, but unfortunately in some instances that's going to be the only decision, only way to exit. So it's planning, speaking to, if you have children, speaking to children, friends, family, because we're going into these things without a plan, it's gonna fall over very quickly, I think.
Cameron?
Yeah, I think from my side, it's probably also about embracing, I guess, what's worked overseas and from a sort of broader financial market structure, understanding that there's various things that where we're limited in Australia at the moment, where we need sort of investor education and market education to sort of improve. So Brett spoke before about the fact that we're the polar reverse of the US in terms of private market lending into corporate. Australia is 9%, it's 91% in the US, and so embracing private markets to allow companies to have greater flexibility, less focus on covenants and those sorts of things is really important, but that comes with a mindset shift at board levels and at CFO levels within companies that are so used to very modest sort of, I guess, leverage and low prices for their debt, whereas I guess in other markets they've identified the opportunity set of embracing other channels, and then on the sort of, I guess, wholesale investor side, it's also embracing probably a bit more risk in the right areas, because we see a lot of people talk about venture capital and growth ventures and other things, whereas Australia is still very immature in that market, and what we would call venture capital here is almost fairly conservative investment when you go into Europe and the US and Asia.
Thank you, Cameron. Brett?
Yeah, so once again, more from the debt side of things, I'd echo the comments on planning. So ensuring all of your ducks are in a row, strong financial records, even things such as business process. I mean, you know, you're handing over the keys to your baby, and the reality is you want that incoming operator to know how to operate the business and get the most out of that business. So a significant amount of planning, ensuring that you know, the going concern will continue, and also having the right transition plan to ensure that the business and client relationships, etc., push forward. So, yeah, just a squeaky clean model with a lot of process around it.
Wonderful. Thank you very much. William?
Yeah, on my end, I did not have a plan when I sold my business. I actually sold it the month after my dad passed away. I sold it because I wasn't passionate about the business, and he was very passionate about his life. So I sort of went through this period where I said, I want to do something I'm passionate about. So I didn't have a plan, which is sort of ironic for someone who was in the business of planning for people's retirement and doing succession planning. But I'll also share a funny story, because you asked what could make it better. And often we hear a lot about like diversity of thought and diversity of teams and all of this. My wife and my son, we were all going into an elevator a couple of weeks ago. I'm the dad, so I hit the door, and my wife had the stroller, and we have a 5-year-old and a 1-year-old. I walk into the elevator. My wife goes, "What's that smell?" And my son goes, "Look out!" So there were 3 different behaviors that happened. The dad walks in, not paying attention. My wife smells something. My son is the smallest of the 3 of us. My other baby's in the stroller, and I literally walked into an elevator, and right in the middle of the elevator, there's dog poop everywhere. So I step in it, and I look down. I'm like, "How did this happen to me?" My son is watching it happen, and my wife is like, "You didn't smell that?" And in my head, I'm like, oh, diversity of thought. This is important, right? So you apply that to this, like what builds competitive teams, because I think in a succession play, again, you have to have like a plan after the transaction is done. And how can I take this business and increase the enterprise value so that later down the line, I have something that I took care of and it's in a better position than it was when I invested in it. Because just investing in the business doesn't necessarily make it a better business. So someone mentioned hiring from inside. Someone also mentioned baby boomers that are in the fund. And I think there's a lot that we, again, as fund managers, we have the opportunity to do to bring our investor base who have lots of experience, partner with teams that have new schools of thought that sort of have this idea flow internally, but they might not necessarily have the resources. And I think right now, something I'm very excited about as a fund manager with this sort of proliferation of AI is that, at least in my circle, I've got a lot of peers that are in their mid-40s, mid-50s, and they're not necessarily super AI literate, right? But I also, because I'm right at 39, I'm in a position where a lot of what I would have done in my 19s and 20s, where I had no resources, I still have the capacity to introduce these types of individuals who have all of these ideas, but not necessarily the capital resources. And for the folks who have the resources, being able to share real experience and say, hey, I'm going to help you see around the corner in this opportunity. And something that I think really does make succession planning better as it relates to purchasing businesses is keeping the idea sort of front and center that diversity of teams really can drive outperformance. And not just being able to, again, find the right deal and say we've got the capital to go and purchase this and sort of the network to roll it up, yeah.
Wonderful, thank you.
Can I add something there? One thing on the teams, I mean, a lot of our DD, 70% of it is done purely on teams, not financial. So I echo that. But also I think we've all got to understand the size of the problem here and understand that tax reform has to also come in. I mean, there's nothing can be, without the government actually having tax reform, I think we're all going to have big problems going forward.
Thank you very much. Sorry, Barrett, would you like to add one thing? So how can we work with or learn from next generation?
I think that goes back to what Will was saying. I mean, we are going through a very significant technological change with AI, and people in their 40s are probably on the cusp of things where you've gone from a non-digital age into the digital age and can probably adapt. But you've got an older generation there who have seen a lot and experienced a lot. So I think getting multiple generations working together, utilising tech and experience is going to be key for a lot of these businesses, because if you look at some of these businesses that have been around for, in some cases, multiple generations or multiple decades, they may have the ability to take on some technological change that can increase efficiency, increase profitability. So I think diversity of teams, not just across thought, but also generations, is a net positive there.
Thank you very much. Thank you very much, everyone, and thank you very much for coming. And hopefully everyone enjoyed. Thank you.